The Australian Securities Exchange today announced its intention to merge with Singapore's stock exchange, provided, of course, it's granted approval to do so by the Foreign Investment Review Board. Opinion is divided as to whether this actually represents a takeover by the Singaporean exchange or a friendly merger. Either way, the proposed marriage partners both express confidence that regulators would approve the deal, which would create a $14 billion stock exchange giant in the Asia-Pacific region to compete in the global market. But not everyone has welcomed the news. Corporate governance advisors and Australian superannuation funds today expressed concern about how such a mega merger might impact on standards of corporate integrity by the thousands of companies that would be listed in the combined markets. Business editor Greg Hoy reports.
Betrothal of the bourses. The Singapore Stock Exchange today confirmed it offered $8.4 billion to merge with the larger Australian Securities Exchange to create the world's fifth largest stock trading hub. The second largest in the Asia-Pacific after India, ASX SGX Limited would list 2,700 companies which have a combined market value of around $2.3 trillion US.
We believe the new group we endeavour to create will be a very competitive global exchange force to be reckoned with.
This historic day is a question of growth. This is a question of creating opportunities, of the growth opportunities that comes out of where we are in Asia Pacific. With the strength of ASX and with the strength of SGX being really the gateway to Asian capital markets, to capital flow that we see today is really changing from west to east.
If you add the assets under management of both our jurisdictions, it becomes second only to the United States as a potential pool of investable funds.
For many Australian brokers, it's a golden opportunity.
I think brokers generally will welcome it because I think it'll encourage investment into our region. When you've got stock exchanges merging in this way and you've got an Asia-Pacific region that is clearly the beacon of light as far as world growth is concerned, there is every opportunity that we'll see more and more money piling into this part of the world.
But not everyone is enamoured with today's announced engagement, particularly corporate governance advisors.
The importance of a healthy market is that financial services at the end of the day all relies on trust. And we saw during the global financial crisis what happens when trust is questioned. And you see liquidity evaporate and you virtual panic. And one of the things that is absolutely fundamental is that in this merger, that is all talked about in terms of improved synergies, increased capitalisation, greater number of products and services, one of the things that doesn't speak with equally loud volume on the announcement so far is that market integrity and governance will be adhered and grown through the regional platform.
Australian superannuation funds are similarly concerned.
If the merger goes ahead, one of the prerequisites should be the continuation of the ASX Corporate Governance Council and the continuation of improved corporate governance in Australia via that council.
For its part, the Australian government response today was to sit squarely on the fence. In a statement, Treasurer Wayne Swan said this is a commercial matter for those involved and the relevant regulators, and as a result, it wouldn't be appropriate for the government to give a commentary. What worries Australian corporate governance advisors and large superannuation funds is at the behest of government after considerable protest over questionable corporate governance behaviour by some, the ASX recently relinquished its supervisory responsibility for listed companies to the Australian Securities and Investments Commission. So what assurance is there that for the merged exchanges, ASIC would still be able to adequately enforce standards of corporate behaviour?
If that assurance is not forthcoming pretty quickly, we'd be profoundly disappointed. Not only would it be disappointing from the perspective of this trajectory of increasing interest in governance around the world, it's also very short-sighted.
The combined group's board and management will be drawn from both companies. Both of the existing standalone exchanges have strong corporate governance traditions, and I don't think you will see going forward any let-up in those standards. In fact, as we aspire to convergent standards, it's likely that the standards will be raised. ASIC and the RBA will stay local regulators of all the existing locally licensed operating entities.
The 7:30 report checked with ASIC as to how this might work, but we remain none the wiser. ASIC is considering the details of the transaction and its implications, we were told. It will be making a recommendation to Government and Treasury on the proposal. There is no timetable. Not surprisingly then, opinions differ as to the chances of overcoming this regulatory hurdle.
You've still got the Australian Securities Exchange with the Corporate Governance Council and its 21 representative members, including all the major shareholder representatives. So we have an important voice for reasonable governance at the table, and we'd like to see much more information flowing in relation to this issue.
I think investors will hopefully, if anything, welcome the lower costs of doing business as far as share trading is concerned, and will welcome the increased pool of funds that are available to them. Hopefully the regulatory environment is safe and secure under ASIC control, and the merger of these two exchanges will simply facilitate an efficient and equitable market.
As shareholders, we all elect the board, so we would expect that the ASX board, in their negotiations and discussions with the Singapore Exchange, are in fact raising all of these particular issues and ensuring that the governance standards that Australia has at the moment are in fact increased, not decreased, if there is in fact the merger.